Welcome to Section 1 of the ASC 323 training series on the equity method and joint ventures. In this section, we will walk through the three investment accounting models, explain how significant influence determines which model applies, and introduce the key standards that govern this area. Let us get started. By the end of this section, you will be able to identify which of the three accounting models applies to a given investment, define what significant influence really means, and apply the indicators that support or rebut it. You will also understand why ownership percentage is just a starting point and which other standards connect to this topic. These foundations are critical before we move into the mechanics of applying the equity method. Here is the key thing to understand before anything else. The three investment accounting models produce dramatically different results on your financial statements. Choosing the wrong model is not a minor error, it is a material misstatement. The entire determination hinges on the level of influence or control you hold over the investee, not simply how many shares you own. Auditors pay very close attention to this judgment call, and so should you. Let us look at what those three models actually are. The first model applies when you own a relatively small stake and have no significant influence over the investee. Under Accounting Standards Codification 321, publicly traded equity securities are carried at fair value, with changes flowing through profit and loss or other comprehensive income. For private company investments without a readily determinable fair value, you use a cost minus impairment approach. The defining feature here is passivity. You are along for the ride, not participating in decisions. When that changes and you start influencing the investee, a different model kicks in. The second model is the equity method, and it is the entire focus of this training series. It applies when you have significant influence over the investee but do not control it, typically when you own between 20 and 50% of the voting stock. Instead of carrying the investment at fair value, you start at cost and then adjust the balance each period for your proportionate share of the investee earnings, minus any dividends you receive. This single-line treatment on the balance sheet reflects your economic stake in the investee performance. The surprising part is how ownership percentage is just a presumption, not a hard rule, which we will explore shortly. The third model is full consolidation. When you own more than 50% of the voting stock, or when you are the primary beneficiary of a variable interest entity, you have a controlling financial interest. Under Accounting Standards Codification 810, you bring every asset, every liability, every revenue line, and every expense of that investee directly onto your consolidated financial statements. This is the most powerful model because the investee financial results are completely absorbed into yours. The equity method sits right between the cost method and consolidation, influential but not controlling. Watch out for this one. Most people assume the 20% threshold is a bright line, but it is not. It is a rebuttable presumption, meaning the facts can override it in either direction. Consider a 25% owner who has signed away all voting rights and is barred from board participation by contract. That investor may have no significant influence at all. On the other hand, a 15% owner who sits on the board, participates in key policy decisions, and has veto rights over major transactions almost certainly has significant influence. Always look at the substance of the relationship, not just the number on the stock certificate. Significant influence is a specific accounting concept. It means the ability to participate in the financial and operating policy decisions of the investee, not to control them, just to participate. When you own between 20 and 50% of the voting stock, US GAAP presumes you have that ability. But that presumption can be rebutted, which means evidence can prove you do not actually have significant influence even at 30%, or that you do have it even at 15%. The next two slides will show you exactly what evidence to look for. These 5 indicators are the ones auditors look for to confirm that significant influence actually exists. A board seat is the most obvious signal. It means you have a direct voice in governance. Active participation in policymaking processes is equally important, even without a formal board seat. Material intercompany transactions, shared management personnel, and the provision of essential technical expertise all suggest a deep operational relationship that goes well beyond passive investment. If several of these are present, significant influence is very likely. Now let us look at the flip side. Here is the other side of the coin. Even at 30 or 40% ownership, you may not have significant influence if the facts point the other way. If a majority shareholder controls every decision and your vote is irrelevant, that matters. If you have actively tried to participate but been shut out, that is evidence against influence. If you signed away shareholder rights or the investment was made purely to meet a regulatory requirement, those facts weaken the case for the equity method. And if the investee refuses to share financial information with you, participating in policy decisions becomes practically impossible. This is where things get interesting. Accounting Standards Codification 323 does not exist in isolation. It sits within an ecosystem of related standards. ASC 321 governs the cost and fair value methods when no significant influence exists. ASC 810 governs consolidation when control exists. ASC 35020 is important because goodwill embedded in an equity method investment is not separately impairment tested. It is tested at the whole investment level under ASC 323. And ASC 820 governs fair value measurement, which you need when measuring impairment and allocating basis differences. Knowing how these standards connect will help you navigate complex situations. Let us bring it all together. The three investment accounting models are driven by level of influence or control, not just ownership percentage. The equity method applies when you have significant influence, the ability to participate in, but not control, the investee decisions. The 20 to 50% ownership range creates a presumption of significant influence, but that presumption can be rebutted in both directions. And ASC 323 connects to a network of related standards that you will encounter throughout your career. Thank you for completing this section on the equity method framework. Thank you for watching. Subscribe for more training from PNJ Group.